Hello everyone, Mr. Lipchick here, and the topic of discussion for today, for this block of instruction, will be taxation. How the federal government raises money. In order to operate, the federal government must raise $2 trillion per year. Much of this money is raised in the form of taxes. Taxes are defined as payments by individuals and businesses to support the activities of government. Congress has the power to lay and collect taxes, duties, imposts, and excises, and to pay the debts and provide for the common defense and general welfare of the United States, according to the Constitution, Article 1, Section 8. Individual income tax accounts for 50% of the federal government's revenue. Taxable income is defined as total income of an individual minus deductions and exemptions. The government allows certain tax deductions for charitable contributions, state and local tax, mortgage payment interest, and business losses. Individuals can take a calculated standard deduction instead. Individuals can deduct for each dependent or person who relies on them for food, shelter, or other necessities. Income tax is a progressive tax, meaning that people with higher incomes must pay a higher rate. Tax returns must be filed by April 15th of each year for the preceding tax year. Employers are required to withhold taxes for employee paychecks in advance of April 15th. This avoids the need to have to pay all the taxes at once. And it provides the government with a steady flow of income throughout the year. Self-employed people must estimate their incomes and pay their income tax 4 times per year, that is quarterly. The Internal Revenue Service, or IRS, is a bureau of the Treasury Department that is responsible for collecting taxes and processing returns. Every year, they audit a number of returns to see if people are complying with tax laws. The IRS will investigate and prosecute criminal violations of the tax code. Corporations must also pay income tax. All income beyond its expenses is taxed. Some avoid taxes by becoming multinational corporations with bases in foreign countries. Nonprofit corporations, such as schools and churches, do not have to pay income tax because they do work that benefits society. And they operate as a money in, money out basis. That is, they must break even every year, and any revenues that they make beyond their expenses must be reinvested in the services that they provide. The government collects large amounts of taxes to pay for social insurance programs. Social Security, Medicare, and unemployment taxes are deducted from your pay. Employers and employees pay equal proportions of this tax. As the population ages, these are the fastest growing taxes. These are regressive taxes. That is, lower income individuals pay a higher portion of their salaries for these taxes than higher income individuals. Excise taxes are defined as taxes on the manufacture, sale, or consumption of goods and the performance of services. These are often called luxury taxes as they are imposed on items such as liquor and tobacco, that is, items that you don't need to survive. And they are also levied on gasoline. And the goal is to reduce the consumption of these items, thereby benefiting society with less pollution, less alcoholism, and less cancer deaths. Customs duties are defined as taxes levied on goods imported into the United States. Sometimes these form protective tariffs. in order to protect domestic industries from competition from foreign goods, and they account for less than 2% of federal tax revenues. There is the estate tax, and these are taxes collected on a person's inheritance from an estate when someone dies, leaves the money. However, these taxes are being phased out. And there is the gift tax. This is a tax imposed on a gift to an individual totaling more than $11,000 in a given year. Taxes in the economy. Tax loopholes exist, and these are tax exemptions favoring certain groups that are often criticized as unfair. Taxes are an issue that is addressed by the political process, often giving unfair advantages to certain groups of individuals. Some people find loopholes in the wording of the laws through tax attorneys. And some loopholes allow businesses to deduct business losses or create tax-sheltered funds. President Reagan signed the Tax Reform Act of 1986, reducing a confusing tax code which contained many unfair regulations. Tax credits were defined as credits that allow individuals to reduce their tax liability by paying for child care, education, or other expenses that benefit society. Many politicians have as their platform reducing taxes as a means of stimulating the economy. However, most economists hold that this is not true. Economic activity is driven by consumer demand, and without adequate incomes, people will not have adequate demand for goods and services. Government borrowing. In addition to raising taxes, the federal government borrows billions of dollars in order to finance its activities. Federal securities are issued, and these are bonds, notes, and treasury bills that the federal government sells for redemption with interest by the purchaser at a later date. Interest on some of these investments is non-taxable. And it is a relatively secure investment with very little risk. As long as we have a government, you will be able to redeem these securities. The national debt is defined as money that the government borrows to cover its annual budget deficits. The debt in and of itself will not harm the economy, provided that it does not get too large. And the debt is created when the government spends more on an annual budget than it takes in. And this situation is then called a deficit. That concludes our discussion on taxation. Thank you for attending, and I look forward to seeing you in the live lesson. Have a great day.